First of all, if you do not take your RMD properly, they hit you with a pretty severe penalty at 50%. Hey everyone, Joe here with IntelliPlan Financial, and today I want to tell you a little bit about RMDs. Now, with the Secure Act that came out in 2020, they have increased the age from 70 and a half to 72. So you don't have to worry about taking any RMDs out of those accounts now until you're 72 years old. Now, some people worry about RMDs a little bit, and I understand why. Because first of all, if you do not take your RMD properly, they hit you with a pretty severe penalty at 50%. But then if you are too worried about it and maybe you take out too much of that RMD, now you're getting hit with too much in taxes. I really wanted to talk about RMDs today because if you understand the rules and how they work, then it's really not so bad. So today I want to give you 6 tips on taking RMDs. So the first one that we're going to start with is know which retirement accounts require RMDs. So for example, any 401k accounts, any 403bs that you have, any 450 simple IRAs, simple 401ks, any of those accounts that are pre-taxed or qualified accounts, you will be required to take out an RMD on those. Now, the second tip I want to talk about is determining your beginning date of when you should start taking them. Now, once you turn 72, you have until April 1st of the following year to then start pulling RMDs. Now, you want to be careful with that though. In the year after you turn 72, then it's going to start being a requirement in the calendar year. So as an example, if you were to turn 72 in this year, 2022, and you waited until, say, March 15th of 2023 to pull your first RMD, you can do that, but then you're going to have another RMD that you have to pull by December 31st of 2023. So what I tell pretty much all my clients is go ahead and pull that RMD the year that you turn 72, and then you know that you have an RMD to take each year going forward. So think of it like that. It makes it a little simpler. Now, the third tip I want to give you is how do we calculate RMDs correctly? So with 401k accounts, if you have an old 401, for example, then you're going to get a statement. They send it out once a year in January, and they let you know what your RMD is going to be for that year, because it is based off of number 1, your age, and number 2, the account value on December 31st of the prior year. So any 401k accounts, any annuities, you're going to get a statement in the mail in January from the company letting you know how much your RMD should be. Now, with an IRA, for examples, an IRA is your responsibility to calculate your RMDs. So the best way to do that is if you go out to the IRS website, there's going to be a calculator that you basically can pull down, print out the form, and then you can plug in your numbers and it's going to calculate what your RMD should be. So not too hard there. Tip number 4 is consider all of your retirement accounts. So again, if you have the 401s or annuities, you're going to get a statement in the mail letting you know what that RMD is going to be. But if you have, say, 2 or 3 or maybe even 4 separate IRAs, you're going to want to calculate what is that RMD from each one of those and then add all those numbers together so that you'll know what your total RMD is going to be for the year. Now, you can choose to take that from one particular account, or you can take something from all of the accounts. But most importantly, you just want to make sure you know what your RMD is for that particular year. Tip number 5, have a plan for any unused distributions. Now, what that means is let's assume you don't necessarily need the money, but you have to take it out. So with that, what are you going to do with those funds? So there's a couple things you can do. Number 1, obviously you can reinvest it somewhere else. But if you reinvest it, you might want to think about putting it into something like, say, a Roth IRA or maybe a life insurance policy. That way it grows tax-free and can be withdrawn tax-free as well. Another option is you could donate it to charity and then have a tax write-off for that. A number of things you could do, but it's just important that you have a plan and prepare for that. And then my last tip, number 6, and probably most important, is just avoid any RMD penalties. And what that means is just make sure that you're not forgetting about your RMDs. Make sure that you are calculating them properly and you're taking them properly every year. So it's just, again, really important that you understand the rules. If you're not sure about this, you want some help, please reach out to your financial advisor that you work with. They should be able to give you some guidance. If you don't currently work with an advisor, reach out to us. We're happy to help you. You can see us on our website. Go to intelliplanfinancial.com and just schedule a call with us and we'll be happy to help you.